Hey there, everyone. Happy Wednesday, April 30th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from actually the Stock Charts headquarters. I'm in the office here recording some content with Grayson Rose of Stock Charts, which should be out right about now, maybe tomorrow morning on Stock Charts TV. We highlighted our top 10 charts to watch for May 2025. So make sure you check that out on the Stock Charts YouTube channel when it's out and about. We're coming to you from a beautifully cool and sunny Redmond, Washington. We're going to have highs in the low 70s tomorrow, it looks like, which will be kind of an unseasonably warm, but very much appreciated. Nice day here in Redmond, Washington. Sorry for the late kickoff. I had to work around some of the content we were recording here, but so glad you're joining me live on Facebook, LinkedIn, YouTube, and X. And hello and welcome to all of you. Sort of a nice finish to the session here. We have the end of the month of April happening. We've got some big earnings after the close, which we'll highlight on. More big earnings coming tomorrow. Between today and tomorrow, quite a bit of market cap represented on the earnings table. So we will update on some of the things that we're seeing, some of the evidence that's changing, and certainly what ended up being a decent sort of mildly, barely an up day after opening a lot lower. With that in mind, let's get to the market recap and see how things played out. Here's the chart of the S&P 500. Obviously, a lower open. The S&P dipped below 5440 earlier in today's session, but by the close, we got back to close around 5569. That's only up about 0.2% from yesterday, but again, compared to where we were at 10 a.m. Eastern, pretty nice recovery from today's gap down. So that's an encouraging. Certainly a finish to the session. That last 30 minutes is where a big amount of those gains came. So again, could have been kind of a down day here, sort of an encouraging day. How much of that was month end sort of optimism, month end sort of a wrapping? I don't know how much of a reason that was, but certainly the last 30 minutes, which is where most institutions start to get active. Certainly more strength than weakness. The Nasdaq Composite, though, noticeably did finish slightly lower, again, only 0.1%. So in the end, this ended up being essentially an unchanged day. The Dow actually finished up about 1/3%, around 40,670. And so that's a nice leading roll there. Small caps, the worst performer of the group, did have a late hour surge, but still not enough to get back above yesterday's close. We'll call that down 0.7%. The VIX, noteworthy, did not move down today, actually moved higher today by about a half a VIX point. Earlier in the session, the VIX was up around 28. By the close, we're back below 25. So again, could have been a much more negative contour to the trading day. Ended up being not as bad as it could have been, but the VIX generally still moving higher by the end of the day. So VIX in this range basically means the market's pricing in heavier moves day in, day out. So the average day would not look like this, according to the VIX. The average day should have much bigger percentage swings. This is more of the outlier than what should be expected normal sort of behavior with the VIX around 25. We'll see what happens here, obviously, when we digest earnings from today and tomorrow. Looking at some other asset classes, and then we'll get to the market carpet, and we'll look at some of the individual charts, obviously, which I think are pretty important to watch here around earnings season. Looking at interest rates, we have the 10-year yield essentially flat. Again, the 10-year yield, the short-term yield, the long bond yield, not much of a change. Even the 5-year point, I mean, these didn't fluctuate a lot. Sort of a choppy session more than anything. Interest rates are essentially holding steady with the 10-year yield just below 4.2%. The long bond yield is below 4.7%. Dollar index up slightly. And again, this ended up being not much of a big movement day across the board. It's similar to previous days in this week. It's been sort of a wait and see kind of market to see how these earnings go. And I think how the market reacts to it. Dollar slightly higher, but again, not big of a move. The TLT, which I glossed over there, ended up down about 0.8% from yesterday's close. Commodities mostly in the red, and I think one of the big stories, one of the big areas of the market moving significantly is energy. Energy was definitely the downside outlier today. It was the worst performing sector of the 11. What's interesting there is we got a lot of earnings kicking off here on Friday. Exxon and Chevron, the two big integrated companies, reporting on Friday. The chart of crude oil not looking particularly strong. The chart of the XOP, which I think is the one that I grabbed. I can't remember which energy ETF I grabbed prepping for the show. I think it was the XOP, which is the oil producers ETF. Not great. I mean, it's just in a downtrend, lower highs, lower lows, below moving averages. Crude oil down 3.5%. Copper prices down over 5%. That's using the copper ETF. Gold and silver ETFs both down about 0.7, 0.8%. So not a great day for commodities. Now, some of those charts like gold and silver, arguably still pretty decent charts, particularly over the longer term time frame, but crude oil continuing to look underwhelming here. Cryptocurrencies, choppy, sloppy, sideways, no real directional follow through. Bitcoin is currently trading around 94,700. That's up slightly from yesterday's close, but it's been chopping around in a range here so far this week. I think the big story from a technical perspective is breaking out above 90, 91, 92,000. So where we're at right now represents a breakout out of a basing pattern that we observed with the chart of Bitcoin. So again, worth watching here. I forget when Coinbase earnings are. I could probably look that up because I have a charting platform with me, but I don't think it's on the tap for this week. Coming up about a week out, right? May 8th. Coinbase, one of those interesting plays on the crypto space without opening a digital wallet or, buying an ETF. It's buying a stock with essentially a direct play on the cryptocurrency space. We'll see what happens. They're not a bad chart. One of those ones to keep an eye on for sure. All right, let's look at the 11 S&P sectors, and we can see more up than down, right? 8 of the 11 S&P sectors in the green. And if you take energy out, which was down 2.7%, by far the downside outlier, most sectors had a pretty decent day. At the top of the list, though, it's not the growthy sectors, and that's where we have a lot of earnings coming today and tomorrow. Healthcare, number 1, 0.9%. Consumer staples, number 2, up 0.7%. Industrials, number 3, up 0.7% as well. On the downside, 3 of the sectors were down after energy, which again had the worst day of all. Consumer discretionary down 0.9%. Tesla got dinged pretty good. Amazon struggling to regain some bullish mojo. Utilities third from the bottom, down 0.5%. So communication services were flat today. Technology up 0.4%. Not a big move. But again, what's interesting about this day is if you look at it, is things after the open, after the latest GDP numbers certainly looked remarkably weak, and it certainly looked like this market could be starting its next leg down. Certainly more optimism through the course of the day as investors bought that initial sell-off. And at the end, we finished more toward the top of the day's returns, right around yesterday's close. So, sort of snatching an okay day from the jaws of a really bad open is how I would describe today's price action. All right, looking at the breadth data, you can see that the S&P actually had the strongest breadth of all. 64% of the S&P members were up today. Only 36% were down today. So 2-to-1 ratio, stocks up versus stocks down. You look at any of the other indexes, though, and you can see it was not that good, right? The S&P was up on a breadth basis, but most of the rest of the equity space was a little more weak, right? So if you look at the New York Composite Index, which is the top one here, 54% down, 44% up. So almost some weird fraction, but more down than up is what I would say. And not a huge spread there, about a 10% spread from decliners over advancers. So the point of this is just to show that the breadth in the S&P was a lot stronger than in other areas of the market. The small cap breadth overwhelmingly negative. So this was not a big, broad risk on kind of day. This was more like the bigger names looked like they held up better and enough to propel the indexes higher. Here are the leading growth stocks. And again, these are important because 4 of these 8 names are reporting earnings today and tomorrow. We've got Meta and Microsoft reporting after the close today. It looked, as I was prepping for the show, both of them up in the after-hour session for now. We'll see what happens as earnings calls get going and we continue to do, unpack some of the language and certainly some of the questions we'll talk about valuations and tariff impacts and all those sorts of things. But for what it's worth today, Broadcom up 0.7%, Apple up 0.6%, Netflix, again, the strongest of this basket of charts, up 0.5%. Microsoft up 1/3% going into today's earnings report. NVIDIA, which has been struggling to break to a new swing high, flat for the day. On the downside, Tesla continuing to not break out above resistance, down about 3.4% today. Amazon down 1.6%, and Meta down 1% going into today's post close earnings report. All right, let us continue on to the market carpet. As a reminder, I can see questions coming in from the different platforms upon which we're streaming: Facebook, LinkedIn, YouTube, and X. I appreciate you guys so much tuning in live. Those of you that are, please drop questions as we go through the charts, as we go through the heat map here. I'll grab a question or two at the end of the episode. Any of the questions we don't get to, we will definitely put it in the Chart This mailbag. We're planning an all mailbag episode on Friday's show. We would love to answer one of your questions on the air. All right, looking at the heat map here, I mean, what stands out to me, two sectors that stand out as sort of the weakest of the group, maybe three. I mean, one, obviously the weakest is energy here, right? Crude oil prices sort of starting a new leg down, it looks like. And while there are areas of the energy sector that are actually doing okay, it's not the S&P energy names generally, right? A lot of these are oil producers, exploration companies, integrated oil companies like Exxon, Chevron, ConocoPhillips. Things that are kind of holding up better are more infrastructure names, natural gas names, and those aren't really represented well in the S&P 500 energy sector members. However, most of these were down today, and I think the story there is crude oil prices rotating lower. I mean, these are the parts of the energy market really tied to the strength or weakness in crude oil. Great. Again, I had a great interview with Rob Thummer, who's a portfolio manager in the energy space at Tortoise Capital in Kansas City. Check that out on my YouTube channel called Market Misbehavior. He had a really good take on why certain areas of the energy market can and most likely would do well, even if crude oil prices are weak. That discussion is really resonating to me as I watch what's happening today with some of these big integrated companies down quite a bit to 2 to 3% plus today on weakness in crude oil prices. Second sector that jumps out to me is consumer discretionary. Certainly a concentration of reddish tones in that sector. Amazon down 1.6%, Tesla down 3.4%. Again, what concerns me about those stocks, I mean, we can talk about the tactical rally off of the early April low. I won't deny that. It has been an incredibly strong move off of the lows. Here's the problem. When the VIX is very high, which is what it's been, down around 25 now, but still above 20, when you have these sorts of volatile movements in the markets, that means sell-offs are pretty exaggerated. That means counter-trend rallies are going to be pretty exaggerated as well. This is when moves in either direction are going to feel very swift and sudden and severe. And the problem is, the challenge is trying to keep a proper long-term perspective through a period of a very noisy, choppy market environment. So, I think you have to take a step back and just focus on what levels, what patterns, what moves would validate a change in trend. And I think for charts like Tesla, they're failing to get above resistance. Microsoft and Meta, again, we'll see what happens with earnings today, but I would say from a technical perspective, they're up against resistance, but they've not broken out yet. And I think those charts can be really compelling if and when we get above resistance. We just haven't done it yet. We've traded to resistance, not through resistance. Let's see what happens, today, tomorrow, and onward. Elsewhere in the consumer discretionary sector, you can see Starbucks, which is an earnings name this week, not going great, actually testing support at 80. I actually meant to grab this chart for the chart review, and I didn't. So I'm going to put it there just so I don't forget to talk about it. But let's go back. Elsewhere, so we will talk about Starbucks in a little more detail. Cruise lines like Carnival, Norwegian Cruise Lines down. Royal Caribbean is one of those names to watch this week. Bouncing up a bit over 200, but for now holding steady around 215, 220. The third observation I would make would be within communication services. The two big names in that sector are Alphabet and Meta, along with Netflix. That's about half of the communication services sector. Both of those names, those first two names, were down today. So again, I think for the markets, for the benchmarks to experience sustained moves beyond what we've seen so far, I think it has to be driven by those mega cap growth stocks. That's just the way that the indexes are calculated these days. We'll see post earnings if we get enough upside follow through to validate more optimism in stocks. And for these names, along with the S&P and the NASDAQ, powering above their 200-day moving average, I just haven't seen enough evidence yet to tell me that's the likely future path. Those three sectors aside, this is sort of a kind of choppy sideways day. You've got random names doing well, and I would say on the upside, if there are things to be encouraged about, three things maybe jump off at me. Number one would be random names doing well in technology. Skyworks, the hard drive manufacturers like Seagate and Western Dig are actually rotating higher. Seagate pushing above $90 a share today. It's up over 11%. It's a pretty nice rally. Western Digital also testing resistance at 45, but up about 8%. So those are areas of the market pushing higher. Within healthcare, right? Look at Pfizer rotating off of an early April low. CVS potentially making a higher low. Some of these have just been really rough chart, like Moderna have just been a really ugly chart for so long. So I hesitate to cite that as a really good improving sort of technical profile. But I would say random names starting to improve in there. I did grab a healthcare name, I feel like, and put it on the list, but I forget which one it was now that I'm looking at the list of tickers. None of these look familiar. So we'll all be surprised as I find which charts I look at. What happens, the way that I select the charts that we're going to talk about on the show is during the day, I'm looking at a bunch of charts randomly, and anything that looks interesting, anything that I want to save, I pop it on a chart list, and then just before the show, I go and reorganize the list, and then we go live. And so sometimes I put it on earlier in the day, and I have no idea what's going to come. It's very exciting. So besides those things, what else did I want to tell you about? I think the last thing maybe would be payment processors, right? You had PayPal as an earnings name this week, Visa as an earnings name today. The charts of Visa and MasterCard probably better than PayPal in terms of their technical profile, right? PayPal has actually, sold off a lot more in Q1 and is still attempting to sort of build some momentum off of those early April lows. But Visa and MasterCard are actually making potentially some new swing highs. I've got alerts set up on both of those to see if and when they rotate higher, but I think that's something to keep an eye on as well. And no real follow through in the defensive sectors. I mean, right on a day like today, when we opened lower, I immediately started thinking about defense, and I don't mean defense like Raytheon and General Dynamics. I mean defensive sectors like utilities, real estate, consumer staples. Some interesting charts in there for sure. And I would say some of the charts like Coke threatening a new 52-week high, Kroger in a nice uptrend. I see them, and we've followed them. But again, like utilities not really surging higher today. You really didn't see that big rotation into any defensive positioning. So that counter trend rally is still kind of the primary trend that I'm observing out here. All right, we'll get to the chart review portion. Matt, I want to thank you so much on YouTube, dropping a super chat, dropping a tip during the show. I appreciate that so much. That doesn't happen often. I can't tell you how much it means to me when someone makes a point of doing that. Glad my work has been helpful for you. In your comment, you wrote for tariffs. I feel like we could all use a little love as we navigate that period, just for the mental anguish of going through this period and trying to value stocks. So thanks so much. I really appreciate that. That very kind gesture. It means a great deal. Thanks so much, Matt. All right, let's look at the chart review and go through what we're seeing here. So again, I mean, if there's anything I'll tell you about this week, the most encouraging thing I can tell you is that the S&P broke above 5,500 on Friday's close. And the big question I talked about with my premium members over the weekend in our weekly flight plan was, do we hold and sustain that break above 5,500? I think the S&P between 5,500 and 5,800 is at worst neutral. That's okay, right? And that means that the market's okay. Below the 200-day, though, I'm still not a huge buyer of things. And, some people have said, what about this big move? And yeah, I think the challenge is there are big swings, right? Swings to the upside and the downside, day to day, week to week, are going to be severe. That is what a high VIX means. This is what investing in a high volatility environment is like. You get big swings to the upside and downside. And I refuse to say I'm a brilliant strategist if the market's going down, and I'm a disaster if it's going up for one day or 1 week. That's just not the way that you can trade in a volatile environment like that. You're either a swing trader and you're trying to capitalize on those moves, which some of you are, and I wish you well. I hope that goes well for you. For me, I'm more of a position trader. I'm looking a little bit more longer term, and so I'm more cautious about reallocating and adding risk to the portfolio until I'm confident that we're going to see further upside beyond the gains that we've seen so far. Getting above 5,500 tells me to start to think about taking on additional risk. I certainly have, equities in the portfolio and ETFs that are more offensive bets, but I'm still more defensively positioned at this point. I think the S&P above 5,750 to 5,800, which clears the 200-day, clears the late March high. I think you'd be crazy to not be stepping on the accelerator at that point, because that tells you we're in a recovery mode. It tells you there's so much optimism that the big names that would do the lion's share of the gains are probably getting done at that point. I'd be very comfortable taking on risk at that point. Back below 5,500, I think you need to be back to thinking more defensively, and I think that's the question between now and the end of this week. Now, one of the big question marks was GDP. It looks like the market digested that number, which basically showed negative change, which isn't good. But the market, markets were bought, equities were bought after that point. So I mean that's one hurdle to get through. We've got PCE data, which is the second big hurdle, and then all these earnings between today and tomorrow. And again, I'm not going to say I know how that all is going to play out, but I would say if the market finishes in a position of strength after all of that, that probably would give you more confidence that we're at least going to retest the 200-day moving average. And I would say that the momentum certainly appears to be aiming in that place. So 5,500 for me is kind of the new short-term floor. That was our upside objective. We will see if that holds through the course of this week. Pretty encouraging after Friday's breakout. Monday, Tuesday, Wednesday, all three of those days closing above 5,500. That's not negative, and I totally get that. And this is why I would say the conditions right now are honestly mixed. And if someone tells you all the indicators are bullish or all the indicators are bearish, I would say they are selectively looking at certain things that validate that point of view, because I'm finding mixed results, right? The S&P breaking above trend lines and breaking above resistance, that's good. I mean, that is bullish. The breadth still looking like what it does is not bullish yet, right? Still only 43% of the S&P above their 50-day. That means most stocks are below that, right? The fact that 37% of the S&P are still below their 200-day moving average, it's just not bullish. That's not a long-term bullish breadth reading. It just isn't. So we can talk about how the market is rallying off the early April lows, not debatable. We can talk about how the short-term breadth has been quite strong. And I will tell you, when that top 10 charts to watch for May 2025 comes out on Stock Charts TV, you should absolutely check it out. I'll make sure that I mention it in my blog and my newsletter, because I think it's going to be a lot of fun. We had a really good conversation, Grayson Rose and I. But one of the things we looked at was this right here. And again, watch it, because Grayson talked more about it. And I would encourage you to sort of check out his take. But this is one of the visuals that we looked at together. This is the breadth for the major averages, the percent of these benchmarks above their 20-day, above their 50-day, above their 100-day, and above their 200-day. Only one of these columns is bright green, and it's the short-term breadth. So most stocks, right, 4 out of every 5 S&P 100 members and S&P 500 members are above the 20-day moving average. That's not bearish. That tells you the tactical time frame has been quite strong. But those same benchmarks, only 39% of those stocks are above their 100-day moving average. 36% of the S&P, only 37% of the S&P are above the 200-day. So what that tells you is that most stocks have had a monster rally off of an April low, but not enough where it tilts and swings the pendulum to this is obviously a strong long-term trend. It's still in the short-term strong, long-term weak kind of definition. That visualization, by the way, which I'm thinking we need to start incorporating into the show, is on the new and updated market summary page on Stock Charts. This was just recently released. I think it's brilliantly done. I'm selfishly saying that because I saw an early preview and gave them some feedback, almost all of which they incorporated into the page. So I'm a fan because it does a lot of the things that I've hoped we would be able to do with Stock Charts, and Grayson and the team did a great job of it. So go to Stock Charts, go to Charts and Tools, click on Market Summary, and you'll get to that updated version. And this is the tab called Breadth, or the widget called Breadth, and I switched to Moving Averages. That's how you can track that all by yourself. So this chart is basically summarizing that and demonstrating that strength. Microsoft up, up for earnings today, and we're going to get to a couple of these charts. We showed this on yesterday's show. Again, with Microsoft, the question is 395, right? That was the resistance in March, in April again. We closed today literally right at that point. That's where I had an alert set, and they were firing earlier. Do we have enough upside momentum post earnings to push above that? Let's look at what's happening after the market. We'll see. But for now, after hours up about 5%, we'll call it. It's actually all the way up here around the 200-day moving average. So that means it's going up to around there. So if that's how we're trading tomorrow, and again, if that's the sort of gap we're trading at, that means short term we're definitely breaking above resistance. And the question is going to be, do we clear the 200-day moving average? And I tell you, if charts like Microsoft can break to a new swing high and break above the 200-day, I will, without a doubt, be way more constructive about charts like this. Again, the reason why I'm not super bulled up on Microsoft yet is not a judgment call. It's just the fact that we haven't broken out, or we've failed to get above resistance. So my training tells me that's not an uptrend yet. An uptrend is we break above 395 and continue further. So if we do open up around those levels, let's see if we hold them, right? If we close higher, it's all going to be all about follow through, but it looks like a pretty nice upside reaction to earnings for now on Microsoft. Meta's another one, a bit of a different layout, because here I'm looking at that swing high in early April, which is right around 580. You can see that actually lines up pretty well with the 200-day moving average, which is almost exactly there. So we've traded up off of support at 480, have been unable to get above 580 yet. Quick check after market up a little bit less, right? 3.7%. So we're around 570. So back on this chart, that means we're currently trading right about there. So still not above that resistance level. So again, for these charts, earnings wins are good. Getting above the 200-day from a technical perspective, that tells you something's new and different. So I think still to be determined. Coke, this was actually one of the 10 charts that we talked about in the stock chart special that I mentioned earlier today. This is one of the 5 names that I brought in. And I brought this up to show what's kind of like a cup and handle pattern, right? It's a cup and handle and handle. I think we showed this on yesterday's episode. You can see these multiple kind of right handles, but the resistance is pretty stable around 73 to 74. We opened higher today, but closed lower, and it did end up about mid-range today. But this is another earnings name. They actually reported earnings yesterday. Coke has outperformed Pepsi, not even close in 2025. Again, a chart like this, I'm pretty much patiently waiting for a breakout. This is a basing pattern. This is a consolidation pattern. I think it's a bullish chart if and when we break above 73 to 74. That's that pink shaded area that we have there. Not quite there yet. We'll see what happens. By the way, as I'm going through some of the charts, I recognize 2 others throwing a tip on there. I appreciate you so much. Tony, thanks as always for watching on YouTube. A fellow Pacific Northwesterner, and I'm glad you caught the Money Show presentation. We did a show earlier today for the Money Show called 5 Key Lessons Learned from 5 Years Interviewing Experts or something. I forget what I called it, but sort of good, nudge your thinking kind of takeaways from a lot of interviews. I'm glad you tuned into that. And Jonathan, thanks for watching on YouTube as well. And then again, thank you both of you for a very kind gesture. I really appreciate it, and glad my content is of help to you. Thanks so much. All right. Not all charts are great. And I think one of the key takeaways is, regardless of what your macro perspective is, right? It doesn't matter necessarily if you're bullish on the S&P 500 and the NASDAQ or bearish, whether or not you think this is a ridiculous short-term rally that is going to roll over any day now, or whether you think this is the most obvious major low in early April and we're just going to continue to recover and that bears are crazy. Whichever bucket you're in, we can all agree that certain charts like a Kroger, right, making higher highs and higher lows are good charts, right? We can agree that CME, or making new all-time highs today, breaking above previous resistance, is bullish, right? Charts in a clear uptrend are constructive. I hope we can also agree that charts like UPS are not good, right? They're bearish charts. And what makes a chart like this bearish? Consistently remaining below downward sloping moving averages is a good way to think of it. That's why when I find a stock below 2 downward sloping moving averages, that tells me find something else that looks better, right? I mean, the life is too short to be looking at a chart like this personally and be thinking this is a great place to put some of my well-earned capital, right? I would love to wait for a chart like this to show signs of accumulation. And that means we start making higher lows. That means we get above the 200-day instead of failing over 16 months to do so with numerous attempts to break out. UPS is another earnings name yesterday, down another 1.5% post earnings. Not good. I mean, they ended up, we talked about this on the show yesterday, ended up, cutting up 20,000 drivers, talked about the relationship with Amazon. None of it's great. I was taught back in the day, look at UPS and FedEx as great market gauges, right? Because when those companies are doing well, that means people are getting stuff shipped to them. That's probably good. That means consumers are buying stuff. This chart has been going out for a while, though, and even through the course of 2024, it was a consistent underperformer. So it hasn't been a great macro gauge because it's been pretty bearish. But as an individual stock, I mean, there's not a lot to be super joyful about for that particular chart. Caterpillar's another one. Now, Caterpillar gapped lower in early April along with everything else. It found an eventual low just below 270 and now has rotated higher. Earnings name today opened higher. Around 315, 316, we'll call it, actually closed just below 310. So kind of came down through the course of the session today. The RSI is dead even at 50. This is another one of those charts when you have steep rallies, but still below a downward sloping 50-day moving average. I feel like there are just other places to find that could be better places to speculate. Now, energy companies getting dinged pretty good today. The worst performing sector of the 11, and it was not even close. Biggest underperformer. I did grab the XOP. I thought that was the chart that I looked at. Look at what happened on this chart, by the way. Gapped lower in early April. You have those couple downside gaps as the tariffs were initially announced. That second day, we had this open here, which was that second gap. Look at how that resistance level right around 115, that is, held a number of times so far in the month of April. And now as we're wrapping the month, once again, we're failing to get above that gap and we're rotating lower. So you have clear resistance, a supply area around 115. We're rotating lower. And the big reason for that and what's driving the underperformance in the energy sector are crude oil prices, right? Here's the chart of crude oil. You can see over the last week, we've gone from, sort of a sideways pause after the early April rally to now rotating lower and making a new low close for the year. So this is a commodity that is underperforming even the rest of the commodity space. If this was a stock, it would not be a stock I would be super excited about because, again, we're having short-term rallies, but below downward sloping moving averages. The last couple rallies, and really even going back here, if you look at the 50% rally, here we actually got a little bit higher, up to the 61.8% level, but failed at the 200-day. Here, after this sell-off, we got right to the 50% point before rotating lower. Here's the high in early April, the high in early April, mid-April, and then we get up to 50%, and that's kind of the peak. So, it's not even regaining half of each sell-off when we rally. So, again, just a classic sort of distribution pattern on crude oil. And at some point, it's going to bottom out, but I'm not seeing necessarily signs of that at the moment. A couple more charts, and then we'll get to a question or two. Royal Caribbean, an interesting one. This was an earnings name yesterday. Some of the cruise lines were up today. Royal Caribbean, not a great day. It was actually down 0.8%. Did get back above the 200-day moving average, gapped above it earlier this month. For now, holding that 200-day, and I think that's key for a chart like this. Taking a shot at a chart that's regained the 200-day, I don't have a problem with. Using the 200-day as a built-in stop, I think is a great way to play a name like this. Limit your downside, but play a potential recovery as we get above moving averages. Could be of interest. I'd like to see better momentum here, though, and that's something we've not necessarily seen yet. Visa, I just wanted to highlight, opened lower and closed higher. And this was an earnings name yesterday, up about 1.2% today. Visa and MasterCard both look pretty constructive. I like the fact that we've broken above a trend line using the February and March highs. A lot of banks, a lot of financial companies look kind of like this chart. Some of the insurance companies have pulled back to the 200-day, and charts like this that held an ascending 200-day moving average. That's just a much better technical profile than some of the growth stocks we've talked about. Just not holding the 200-day and failing to reclaim them from below. Starbucks, an earnings name this week as well. Not great. We actually opened quite lower. By the end of the day, we rallied up to close around $80 a share. That's still down almost 6% from the close yesterday. So earnings were not good. I guess encouraging that the gap lower was bought today, so we didn't really make a new low from early April. So that might be a sign that we have kind of a double bottom type of pattern here. I think a break below that April low, a close below there would be pretty negative. And again, with that sort of resolution to the what looked like a straightforward pennant pattern, not a good look for Starbucks. All right, final chart that I will show you, Eli Lilly. I highlighted in the healthcare sector a number of charts looking kind of interesting. Eli Lilly demonstrating what we call the gap and run pattern, where you gap higher in mid-April and then continue to drift higher. They actually report earnings tomorrow, so we'll keep an eye on that through the remainder of this week. But I think the fact that we gapped and now are running higher going into tomorrow's earnings report is certainly not bearish. Now the problem is we're facing key resistance right around 925. That was the peak from the end of February, beginning of March. So I would love to see a break above there, and if so, pretty good chart, basically signaling further upside potential in a pharmaceutical name many of us are familiar with. All right, thanks so much again for a number of you throwing a super chat in there. I appreciate you guys so much watching and that very kind gesture. Thank you very much for that. Let me take a question or two before we wrap. Let's see. So a number of comments on earnings, and Chuck, you mentioned I'd be shocked if the coming earnings news had anything good to say. What's interesting is, from what it looks like, the story for earnings season up until now has been companies beating their quarterly results, so beating their estimates for the first quarter, but either lowering guidance for the year or just eliminating, they're just taking their guidance off and just saying we can't figure out what the right number is to share with you today, is basically what they're saying. I don't know what they're actually saying, but it's kind of what they're saying is we really don't have a good read on it. And I think that uncertainty generally is going to weigh on the markets. But having said that, it looks like some of these growth companies are gapping higher on earnings. For me, it's all about sustainability. After hours trading is kind of choppy and very reactionary to what is being heard moment to moment. Let's see what happens tomorrow, and if buyers actually come in and continue on. Richard, you asked, Dave, are you planning on giving an assessment on the first 100 days of the Trump administration? I don't mean to laugh at your question, but I appreciate it. It seems to be the thing to do. I mean, I tell you what, I'm happy to give you a technical assessment on anything you want. I'm not the person to pass judgment. I have plenty of opinions about certain things, about political things and otherwise. I try desperately to separate that. And if you struggle to figure out what my general political leanings are from the content I'm putting out, I feel like that's a good thing. I feel like too much is polarized, and I'm definitely someone who likes not polarizing. I wish we all came together. And to be honest, I'm actually more of a moderate than anything, is how I would describe myself. So it's lonely in the middle, but I would tell you, no, I'm definitely not going to be one to pass judgment on a public platform or anything political. I will tell you the potential market impact, and that's what I see as definitely the role that I'm going to play. And I would say the way that I would summarize that, and I might make time for this on Friday's show and a little bit more. I mean, the problem I have with everything, it feels like everything that I've heard, again, regardless of what I think personally, the direction that things have been going in terms of policy decisions are pretty widely supported. It's the magnitude and the way that is actually going that the administration is going about it that is bothering a lot of people. And I would say I'm probably in that group in some way. There are plenty of things that certainly could improve in the U.S. and in global structures and politics, but the severity and the methods which are being implemented are what are not getting a lot of favorable responses from voters right about now. And so I think the problem right now, when I look at the first 100 years, is that uncertainty is injecting unnecessary volatility, and volatility is not great, right? In terms of uncertainty, right? The market doesn't like uncertainty. If you're trying to use stops, your stops are all getting blown out. You have to use these crazy wide percentage swings that we all have to deal with. It's a lot better when those aren't the story of the market. So I think the challenge I have is the methods which are being employed by the administration are causing a lot more volatility than they probably need to. And so I think a gentler approach to certain things would probably end up being a better way to do it. That's my take on it. Again, not a political take, but more just a market structure. And as an investor, I think that would be certainly better to make sense on. What else can I answer here? And thank you guys for throwing some great questions in here. Yeah, Dave, at what point is oil so cheap you gotta buy? And thanks for watching on YouTube. So again, that's not the way I generally think, right? And I think that is a dangerous that approach of when something gets so cheap you have to buy it. It's really more of a contrarian approach and really more of a falling knife kind of approach. If your runway is long enough, I think it's a decent way to approach things. And I'll give you an example about that. This is a stock I will admit that I own. I have a position in Disney. I have a position in Disney in a retirement account. It's not a position I'm expecting to tinker with very often. It is a long-term holding. There's certain companies that I think are good long-term holdings. They are, not technically driven. They're more. These are themes and ideas and companies that I think are going to be long-term gainers. Berkshire Hathaway has been one of those that I've probably owned. I don't know, 15 years or so maybe would be my guess. I have to look at when I actually opened my first position in that stock, but it's been a great long-term position. The chart of Disney, this weekly chart of Disney is why I bought the position. And I bought it because Disney was trading at a very low level relative to where it's historically been. I love the company. I love the vibe of the company. I like the brands that are involved. I think that could work. So, that buying weakness, even if the chart isn't good, but it's a long enough runway that I'm not worried about the movements between now and then. I just think it's going to gain value over time. That I don't have a problem with. So, buying crude oil because it's down, based on where it's been recently, I think is a tough one. Looking at the long term structure and thinking how low could oil prices get. That I guess that's the argument that you're trying to make. I mean, for me, I think for me, oil is not one of those things that I think oil is always going to gain in value, right? Something like Berkshire Hathaway, I like the long term value. Something like Disney, I think buying it at a low valuation makes a ton of sense to me. Buying crude oil because it's down a lot, I don't think fits into that same bucket. Because I think there's going to be a lot of things that cause pressure on crude oil prices, and again, a lot of the technologies that have been implied in the U.S. Certainly making oil more plentiful, making the U.S. less dependent on foreign oil. None of that screams to me prices going up. I feel like there's a lot of that going on. So for me, probably not a point where I would just say, "Wow, oil's so low, I need to be buying it." Let's see. Any thoughts on international markets? Jeremy, this will be the last question. Thanks so much for asking it. Any thoughts on international markets? EFA looks like a good chart. Yeah, I was actually not looking at EFA, but I was looking at um, VEA. Is that true? No. What's the one I was looking at? Oh yeah, VEA. I thought that was emerging markets. It's not. VEA, developed markets, global development. So I was looking at this earlier. I mean, talk about a crazy V bottom, but if you think about it, excuse me, everything kind of gapped down in early April, right, due to the tariffs. But look at the chart of Meta. It's kind of down here. Microsoft's kind of down here. Nvidia's kind of down here. Here's developed markets, which is like developed Europe and Asia, like Germany, France, Switzerland, Japan kind of companies making new all-time highs this week. I mean, the chart's kind of just pushing higher. And on an unadjusted basis, it's not quite to a new high. The September peak is a little better, but it's completely recovered from its mid-March 2025 peak. It's there this week, and I was looking at that because it's something I actually do own in my momentum-based portfolio. I have a core position in an account that I manage. I just rotate once a month, and I've been in developed markets. So this is an ETF that I own, and I was looking at it, probably a similar reaction to what you saw, which is the chart looks pretty good. And so non-US markets generally, not as much emerging markets. That depends sort of on where you're looking. But with developed markets, certainly quite strong. And on a relative basis, incredibly strong year to date. A lot of that story is the dollar, right? And the dollar's weakened to the point where non-U.S. markets are looking pretty strong. And so I think from a technical perspective, a lot of these charts are in a much better position than the U.S. markets at this point. At some point, maybe that changes, but for now, again, as I sign off every show, it's always a good time to own good charts. I don't know about you, but that's a pretty good chart. We'll see if it can clear resistance, but for now, pretty decent. Folks, I want to thank you so much for joining me here on the show. Those of you tuning in live, I appreciate it. Sorry for the late start. I'm in a different location than I normally do the show, so I was fumbling a little bit getting things around, but hopefully some good charts and context and ideas for you to think about through the evening. That'll do it for today. Thanks so much for watching me. I'm Dave Keller here at Market Misbehavior. Have a great night, and remember, it's always a good time to own good charts. Take care, folks.